If you're still skipping candles, you're skipping profits. Candle range theory exposes how one candle can predict the next major move before it even happens. In traditional market structure analysis, we evaluate price by observing highs and lows, key swing points that mark the beginning and end of price legs. But candle range theory shifts this perspective entirely. It shows us that each individual candle, even just one, forms its own isolated range, holding within it internal liquidity, manipulation, and imbalance. This means every candle contains a high representing range liquidity, a low also representing range liquidity, an open revealing directional intent, and a close signaling a shift in momentum. But most importantly, these levels don't just reflect price, they attract price. Now, in this video, we've simplified the entire concept of candle range theory into several actionable steps. So let's jump into step 1, which is how to identify trade setups using CRT. At the heart of this model is a powerful 3-candle sequence that highlights trade opportunities with near-surgical accuracy. Here's how it works. Candle 1. This candle defines your range. You mark. The high, that's your candle range high, and the low, that's your candle range low. These become your primary liquidity zones. This framework, well, it can be used on any time frame. However, there are specific criteria to determine which candles are ideal, and we'll go over that later in the video. Candle 2. This is your trap candle. Price pierces either above the candle range high or below the candle range low, but fails to close beyond it. This move is your liquidity sweep, your signal of market manipulation, and it's critical. If the candle were to close outside the range, the CRT setup becomes invalid. Candle 3. This is the move. After liquidity is taken and structure shifts, this candle becomes your entry trigger. You'll be looking to enter on a bearish fair value gap or order block for short trades, or a bullish fair value gap or order block for longs, targeting the opposite end of the initial candle's range as your first take profit. So now that we've broken down the theory itself, let's walk through how to actually use it as a strategy to enter trades. Using the 3-candle CRT model. First, identify and mark the high and low of the first candle to define your trading range. Next, wait for the second candle to fully form, then zoom into a lower time frame. Because inside the second candle lies the true blueprint. Here's what you're looking for. 1. Liquidity sweep. Price takes out the high or low of the previous candle. 2. Change of character. A structural break showing momentum shift. 3. Fair value gap formation. An imbalance offering institutional entry, or an order block if no FVG is present. You're not guessing entries. You're reading the internal anatomy of the trap candle and targeting the low of the first candle's range as your first take profit, which the third candle fulfills. So, to summarize, candle range theory is really a multi-time frame powerhouse. You analyze on a higher time frame, but you actually enter on a lower one. This approach, well, it allows you to pinpoint entries, reduce drawdown, and optimize those risk-to-reward ratios. Here's a quick guide on time frame alignment. When you're trading a monthly CRT range, you make your entry on the daily time frame. For a weekly CRT range, the entry is on the 12 or 4 hours time frame. If you're trading a daily CRT range, you'll want to make your entry on the 1 hour or 30 minutes time frame. And for a 4-hour CRT range, you enter on the 15 or 5 minutes time frame. Remember, the candle holds structure. You just have to zoom in to decode it. And yes, this analysis applies to bullish setups just the same. Next up, every range contains 2 zones. There's the premium, which is above the 50% mark, and that's really the optimal selling zone. Then there's the discount, which is below the 50% mark, and that's your ideal buying zone. If you're entering short, your fair value gap should be within the premium. If you're going long, it should be from the discount zone. This, honestly, adds logic and precision to your trades, because you're not just following structure, you're entering at the best price within that structure. So now that we've covered the basics of candle range theory, let's move on to the next step, which is that a setup using candle range theory doesn't have to involve only 3 candles. We began this with a simple 3-candle setup. Just to explain the concept, it does even within a single candle. The important criteria is that the market structure displays a clear AMD formation, which means accumulation, manipulation, and distribution. These are the 3 phases that represent the ICT concept, called the power of 3, And it's only after confirming the first two phases that we look for trade entries during distribution. Let's examine a chart to explain the multiple candle concept of the CRT strategy. We begin with the first candle to define our trading range. Next, we see 4 candles that don't shift price significantly. This is the accumulation phase. Then, a candle sweeps liquidity, manipulation phase. But it's crucial that this candle closes back within the range. If not, the short setup is void. Then comes a bearish candle that pushes toward the candle range low. This is distribution, completing the setup. This is where we look for our trade entry after confirming manipulation. So the takeaway here is that the important part of this strategy is finding the correct market structure in the form of an AMD model. And with this understanding, we can even find setups that involve only 2 candles. But to explain how this works, we would have to look at this second candle on a lower time frame. And here we can again see that we have another AMD model with an accumulation phase, followed by manipulation in the form of a liquidity sweep, before price then pushes down during the distribution phase. And in terms of market structure analysis, we can see where the price creates a change of character after the liquidity sweep, before then using the bearish fair value gap as the catalyst to attack the candle range low. So the point is that time is relative, so there is no specific amount of candles that you can expect a CRT model to complete within. The important part is making sure that the correct market structure is present. Other confirmation methods can also be implemented on this model. Let's break down the 2-candle CRT model and how you can refine it further using candlestick confirmation. Once the first candle forms and establishes your trading range, you drop down to a slightly lower time frame, not too far. It should be significant, just a single step lower. So for example, if you're analyzing the setup on the daily time frame, you'll want to shift down to the 12-hour or 4-hour time frame for confirmation. At this point, you're not just watching price, you're looking for confirmation through candlestick patterns. Here's what you need to see. A pin bar, signaling rejection and potential reversal, or a bullish or bearish engulfing candle, signaling a momentum shift. Once that pattern forms in alignment with your CRT structure, it becomes your entry trigger. And your first take profit? Well, it's the low of the original candle that defined the CRT range. This approach adds another layer of precision to your trades, as you could miss a lot of trades that doesn't retraces back to your FVG or order block when trading with the change of character model. But you're not just entering because a structure is in place. You're actually waiting for visual confirmation of rejection or dominance before pulling the trigger. It's structure plus confirmation, which equals smart execution. Now let's talk about the single candle CRT setups. This works a bit differently because, the candle's range hasn't yet fully formed if trading with daily. So here, we rely on session-based models using the same concept, AMD, the power of 3. We make use of market sessions, which involves first the Asian session, then the London session, and finally the New York session. The Asian session usually represents the accumulation phase and sets your trading range. The London session, on the other hand, represents the manipulation and confirmation phase, while the New York session represents the distribution phase. Now, this is the most common representation of the various phases, but honestly, the market isn't always accustomed to just this pattern, so it does vary. In a situation where the Asian session doesn't actually accumulate but instead distributes, you should expect accumulation during the London session and manipulation during the New York session, or, vice versa. It all really begins with the phase the Asian session initiates. So this is the ideal structure, but remember, it's not a guarantee. This is trading after all. You really have to react to what the market presents, not just act based on your assumptions. All right, now let's move to the next important piece. When should you actually use CRT, and when really shouldn't you? Before we continue, don't forget to like and subscribe. Thank you. CRT is honestly incredibly powerful when it's used in the right context. For example, you might spot a bullish candle, and then a trap candle that sweeps the candle range high. At first glance, it might seem like a valid CRT setup and you want to sell, but context is everything. Take a moment to zoom out, and you'll notice that this setup actually contradicts the external market structure. The broader trend is bullish, so you should be looking only for buying opportunities. And even if you wanted to counter trade, something I usually advise against, this is forming at support. Selling at support is a recipe for failure. So despite appearances, the setup lacks the necessary context. Sure enough, when price unfolds, the trade fails as buyers take over. Key questions we should ask before trading CRT. First, are we near a key POI like a FVG or order block? Second, are we targeting an external liquidity or trading away from an external liquidity? And third, does higher time frame structure support a reversal? Now, here's a different example. Another CRT setup, this time aligning with the higher time frame trend, sitting on a major point of interest and forming after a clear liquidity run. Perfect conditions. This is what CRT is built for, spotting reversals. It's a great tool for identifying whether price is running liquidity or sweeping it. But always confirm on the lower time frame. Don't trade higher time frame setups without understanding what's unfolding beneath the surface. Lower time frames offer surgical entries and confirmation. Key takeaway: CRT is a powerful lens to view the market, but it must be applied in the right context. Know when to use it. Know when to wait. If you found this video valuable, leave a like and let us know which trading concept you want us to break down next. Happy trading from DMFX Trading School.